something bad like this does not always need to translate into a financial stability credit event, like a one Jacques Lehman thing. But however, it could be a slow moving train wreck in the sense that it just means that the resilience of the economy and consumption would be much lower because people won't be able to borrow. I think 30% adjustment in the S&P 500 is not out of the realm of possibility.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest had one of the best track records last year in forecasting key economic indicators like the rates of inflation and unemployment. Well, now that we've got a new administration in place, one aggressively deploying disruptive economic policy changes, where does she see the key indicators headed from here? To find out, we've got the good fortune to speak today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economics Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Happy to be here again, Adam.
Thank you. I'm so looking forward to this conversation. You could not be a better guest for a more topical topic, which is tariffs. And the day this is being recorded is the day before Liberation Day. So we're recording this on April Fool's Day. The day it's going to launch is going to be the day after Liberation Day, where people are going to have an awful lot of questions about all this. So again, like I said, you're the perfect person for this moment in time. So we're going to get to tariffs in just a quick second, but very quickly, if we can, Anna, let's just, since it's been a little while since you've been on the channel, let's just do a quick refresh and sort of how you see the world right now. What's your current assessment of the global economy and financial markets?
I think that the sentiment data, so consumer sentiment, small business sentiment, they are all coming off from a honeymoon period, which is actually perfectly forecastable. If you look at past, presidential elections, the improvement in consumer sentiment typically lasts 5 to 6 months. And so we are basically right on time for the souring of the sentiment. Mm-hmm. But I think what makes the current moment more tricky or nebulous than other transition moments from one administration to another is that we are also coming off of 4 years of extreme fiscal stimulus. And this new administration not only are announcing new ways to downsize the government, which has exacerbated a lot of these souring of the sentiment that was going to happen anyway, but on top of that, there were these stealth fiscal stimulus that's been boosting the economy in the past 2 years that are just expiring and fading away. And in fact, even if Trump were to do nothing, many of these expiring fiscal stimulus were going to be dampening economic growth. So basically, the economy, U.S. economy, is experiencing the double whammy of new administration policies that's accelerating underlying vulnerabilities of the economy. And of course, the third whammy is that the world economy will be affected by all this, and the uncertainty of it all is going to, I think, bring down, slow down economic growth. So altogether, it seems clear that at least in the next 3 or 6 months, the outlook is not bright.
Okay, outlook not bright. So this issue of a downshifting of the fiscal stimulus, as well as a removal or ending of the stealth part of that fiscal stimulus, it's a big deal. It's something that a couple folks who have preceded you on this channel have warned about. Most notably, I'd probably put Michael Howell and Darius Dale at the top of the list. I'm sure you're familiar with their work. At our recent conference for Thoughtful Money, Michael walked in detail through what he called the not QE and not yield curve control that he believes that or calculates that the Fed and the Treasury were engaged in over the past couple of years. And as you said, showed that is really ending now here. And Michael's Michael's lens is all about capital flows, and when capital flows start diminishing and then perhaps even shrinking, that's when he starts to get real worried about markets. Economic growth and markets. Sounds like you are seeing through a similar lens. All right, so we'll start with this not bright outlook, given all the reasons that you mentioned. That is kind of the big trend that's going on here. Let's talk for a moment about specifically tariffs, because that's creating a lot of the immediate uncertainty that's going on right now. We have this whole Liberation Day this week, as I talked about in the intro. I guess first off, Anna, leading up to the end of last year, you and your team there at Bloomberg Economics had your forecasts and whatnot. How do these Trump tariffs, sort of the scope and the scale of them, how have they impacted your economic outlook, if at all, now that we're in 2025?
So first of all, Adam, there are many economic forces that's hitting the economy at the same time. And tariffs have been receiving the most amount of attention in news and how people absorb news. But tariffs actually comprise of only about 10% of total U.S. consumption. So you could certainly tariffs and the uncertainty of tariffs is going to be dampening growth. But on the other hand, what's also driving a lot of what we're seeing are, number one, the student debt, the aftermath of the grace period for 4 or 5 years grace period of student loan forbearance, and the plunge in credit scores that's going to be affecting 9 to 10 million borrowers. And second, the fiscal stuff that's happening, which is also a pretty sizable shock to the economy. So, but on the tariff front, I think what we have seen so far is just a temporary boost in production and ISM manufacturing, or just generally manufacturing, trade and logistics sector. So we haven't actually seen the negative impact of tariffs in the imprint of hard economics data yet. If anything, it will be contrary. So this front running in anticipation of the Liberation Day tariffs is one of the biggest front running we have seen. I mean, compared to the front running of the tariffs in 2018 and 2019, this was of several magnitude bigger. Back in the first Trump administration, it was barely, you can barely detect this firm's front running. But right now, we have seen imports surged in the last 4 months, and so inventory also has been increasing. So what this means is that the hard data we have right now is showing production has been pretty strong. Manufacturing payrolls in the last the February's jobs report was this very surprising gains in job gains. And also in this Friday's jobs report, so, we're going to get the March jobs report this Friday, and we are expecting that the trade and logistics sector is going to have a very strong showing of hiring. And so these are all short-term positive effect of the tariff. But the question is, what happens when the tariffs are actually implemented and these front-running activity stopped, right? So given the size of the run-up of this front running on inventories, on production, on imports, what all these means is that it's potentially, what April 2nd means is, after these massive tariffs are immediately in effect, no more front running. So firms are just gonna, hang on to their existing inventory, barely adding to new orders. This is why when you look at these forward-looking new orders indices now, they're plunging, because firms have already front ran for 4 months, and they probably are foreseeing that they have enough inventory until June. And so I think I have to separate the impact of tariff into 3 phases. I will do so, and I will separate the impact of tariffs. Actually, how about this, Adam? Let me rephrase. I'm going to separate the impact of tariffs into four phases. The first phase is in anticipation of the tariffs. And this is basically what we have since November and up to April 1st. And what happened is there are a lot of temporary positive effects showing up in payrolls, manufacturing, production, imports. Phase two happens after the tariffs are imposed. And so suddenly you have this freeze of activity. This is what I'm forecasting, because the buildup of the inventories from the 4 months have enough to last firms for 3 or 4 months. And then in these 3 or 4 months, the firms are going to see whether, and they're going to be hoping that President Trump would be negotiating with countries and lowering some tariffs and give them more clarity that these tariffs are not going to stay. And then after this 3 or 4 month period where the firms are kind of in this subsistence mode, then you get into the third phase, which is, okay, now what are they going to do? Are they going to, judging at the demand situation of the economy, are they going to build back up now their inventory, or are they have demand plunged so much that they decided a recession is here and that they are just gonna be sticking with their low inventory regime? And also they would be grappling with the issue of, well, if they're going to buy more, they would need to think about, are they going to pass through these prices? Because in the phase two, where it's like subsistence mode, they won't be pricing through the tariffs just yet, because they have these goods they have in the inventory are bought from before the tariffs, right? So they can go on for 3 or 4 months without passing prices. But the point where they really need to think about, are they going to build up tariffs? Are they build up the inventory again? Are they going to pass the prices? That's the phase three, right? And that entirely depends on the demand condition of the economy. And so that would put us in about the third quarter of this year, closer to fourth quarter. And that's actually will be a critical moment for the economy, because it will be clear basically around in the third quarter of this year whether the pass-through, whether inflation is about to rise, because many firms are able to pass through these prices. And if they are able to pass through these prices, it would suggest that demand conditions are actually not very weak. I mean, I think the only macro circumstance where we will see economy-wide pass-through into consumer prices is if the economy did not tank and the stock market is still doing really well. Well, in that case, inflation will rise, and then the Fed will not cut at all by the end of this year. So that's one path of where clarity will reveal itself by the third quarter. But on the other hand, if the other path is that firms can't pass through these tariffs in the third quarter, it suggests that the economy is tanking, and all these negative fiscal impulses from DOGE layoff and grants cutting are finally won all these court cases, and they're able to implement these federal workers who have been laid off finally roll off the federal payrolls. We're going to see unemployment rate rise briskly in the second half, in the third quarter, in the fourth quarter. Then in that case, there is the limited pass-through in inflation, and also the Fed might be cutting a couple times at the end of this year. But regardless, Adam, there's a lot of uncertainty about how inflation will behave in response to these tariffs. But there's one thing that's pretty predictable, is that the stock market will not do well in either path that I laid out. In one path, firms cannot pass through the price increase, so they're taking a margin hit. So obviously earnings will take a hit, so stock prices will suffer. In the other path, they are able to pass through these prices. However, the Fed will start not cutting rates. In fact, they will even have to hike around the turn of the year, because firms are able to pass through the prices. So stock market will also tank. So in either way, the stock market, it's pretty clear what direction the stock market is heading.
All right, super fascinating. So I was going to ask you there in a little bit. I'm getting a little bit lost on what the step 4 is, but I kind of get the step 4 now. It's stock market's not going to do well. And it's not going to do well because at the end of step 3, we'll wait to see what happens in terms of what they're going to do with pricing and the tariffs. If they can price them in, that's bad for the markets for the reasons you mentioned. If they can't price them in, that's bad for the markets because the economy is rolling over.
Yeah.
Okay. All right. Anna, that's the perfect answer. Super specific, very logical, very actionable for people that agree with what you think might happen there. All right. So right now, even though people have been thinking of tariffs as a negative thing because, oh, they're creating the stock market uncertainty right now, you're basically saying like, hey, this is like the honeymoon period for tariffs. We've been front running. All these orders have been coming into America. That's probably been, pulling future demand into Q1. So Q1 is going to look pretty good. But then Q2, which is really where we are right now, starting this week, we get into the freeze, right? And we're going to see what happens with the negotiations, how long these are going to be. Companies are going to be just subsisting off of the inventory stockpiles that they've built up here. Presumably, that's not going to make economic growth look super spectacular in Q2. But again, I think folks are probably willing to give it a buy, depending upon what phase 3 looks like when we get there. We won't know, so we'll be tracking this stuff closely. And I will be, and hopefully many of the viewers here will be reading your work very closely, Anna, as you track this for us in real time. Okay, so that's super useful. Now, you mentioned there were kind of 3 big things on your mind. One was the let's say the disinflationary impact of the downshifting and the fiscal stimulus. And it sounds like you lump a lot of things into that. Doge is in there, a lot of the other things that the government is up to right now. The second you mentioned were the student loans. And real quick, I just want to make sure I wrote down the right number. About how many borrowers that have loans out right now?
Outstanding borrowers,
Yeah.
around, I believe, between 30 to 40 million have student loans. But of that, the New York Fed expects about between 9 to 10 million will see they are the ones who will be experiencing a credit score drop because they have been delinquent on their loans for over 90 days.
Okay. So 10 million that fall into the potentially, we would expect to fall into potentially the distressed category.
Yeah.
And do you know kind of off the top of your head to sort of order of magnitude what that represents in terms of total loan debt for that category? Like, do we know the average borrowing
Yeah.
per lender or per borrower?
So the average amount outstanding is highest for the baby boomers, people or people who fall into the age group of 51 years old or above, and I believe it's around 34,000 per person. That would be the average amount. But I think the key impact is not the direct loan that's going to be in delinquency tied to that person. It's more of the wider impact of credit quality in the economy, because credit score is used in underwriting loans for a lot of asset classes. So mortgages, autos.
Right.
So if you are a credit risk manager for any of these, and you look at your credit quality of your loan, and you see that the average credit score has declined by 100 points, then you realize that, well, the loans that you've written in the past couple of years was not as high quality as you thought it was.
Right.
How would that affect your forward-looking behavior? So the reason why the student loan credit score thing is important, I would say, a sleeper shock in the economy, is because, number one, it covers about 10 million people, and number two, credit score is a kind of a transmission mechanism of credit quality. And so far in the last 3 years, the dog that did not bark on recession is credit spreads.
Right.
And I think one key ingredient of a credit crunch is the uncertainty of your credit risk. In the past, when you look at financial crisis, Um, there's a sizable literature that look at how financial crises could sometimes come from the asset side of things, where when one asset quality suddenly deteriorates, then the portfolio manager would have to pull back on the other fire sale, the other asset, right?
Mm-hmm.
Right. And that's often case the mechanism of how something that starts with poor risk in one tiny sector spreads to more, right? And so far, in the last 4 years, when you look at all the balance sheet, household balance sheet, corporate balance sheet data, you'd be like, quality is pretty good, and household debt to income ratio is like the lowest, in many years. However, I think that this credit score, uh, massive credit score drop, actually tests that narrative, which is that how much of that good quality really is just a suppression of the credit score metric. And because if I look at this, the time series of the average credit score of outstanding mortgage loans by by credit score quintiles, we are currently about 50 to 80 points lower than 2009, right? But if you think that there's on average a credit score inflation of 50 to 80 points, in fact, the true average credit score is actually closer to than 2009 level. Then, that's, I just think that this is an area that not many people are concerned about. And I think it could potentially be an important thing to look at it. But certainly, I think the immediate impact we'll see is that there will be a pullback in demand after this, initial phase one of tariff, because right now people are front running the cars tariff by buying cars. There's now a headline on the Bloomberg terminal today that says GM Hyundai sales climb as Trump tariff fears spur U.S. car buying. So we're still in this honeymoon phase one period, but then in the phase two, people not only are these cars more expensive, the credit scores decrease also led to more people will be seeing higher financing, more stringent financing terms when they go to buy cars. And a lot of the people, and when you look at the demographics, the demand of cars by demographics, most of the used car buyers are between age 35 and 49, which happens to be the age group that carry the most amount of student loans. And the people who buy who dominate the new cars purchasing are people who are above 51 years old. And so I think that the direct and the most rapid impact of this credit score issue would be how it affects autos demand post implementation of tariffs. And another issue is the housing sector. So, our new Treasury Secretary, Scott Bessent, has said that the Trump administration is making the 10-year yields, decline in 10-year yields as the metric for what they're focused on, because they want to unfreeze the housing market. But then if the mortgage underwriters became more stringent in writing these loans because of this credit score, and this new generation of home buyers, Gen Z, the millennials, Gen Z, they're the ones who are seeing this plunge in their credit score, and they will have a hard time qualifying for mortgages in a situation where housing prices are still super elevated compared to historical levels. So I think this will eventually also affect housing demand, even as 10-year yields fall.
Okay, so this is so fascinating. So I want to just clarify a couple of things and try to connect some dots here, if I can. Because what I'm hearing you saying is that I think you used the term sleeper shock. There's this potential kind of grenade or bomb that may go off here around these weakening credit scores that could impact economic growth much more than maybe the system is aware of right now. That's the punchline I'm taking from you. But you mentioned some really interesting things. So first off, Did I hear you correctly that there is inflation in credit scores? And so we almost need to, just like we have to back out inflation to get a real number, right? Like real GDP. Do we need to start thinking about credit scores in real terms?
I I think so. I mean, even credit companies are have written about it. I mean, I think they call it the FICO drift. The FICO company, for example, have talked about this FICO drift, and I believe TransUnion has also written about it. And also, um, you know, I Adam, you know that I had worked in the White House in 2019 to 2020,
Hmm.
and during the pandemic, the Office of Financial Stability at the U.S. Treasury and CEA, we bought a massive data set from Equifax, the credit bureau, because we wanted to. This is early in the pandemic, right? In February, March of 2020, because we wanted to understand how the fiscal stimulus will affect the balance sheet of households. And so I was at that point looking at weekly data of the, household balance sheet. Of course, it's all confidential or everything, right? But you just get a very good sense of how households are doing. And I remember the conversation very clearly, the conversation with the credit officer at Equifax then was this issue of how the credit company is going to record or track the credit score given all these forbearances on mortgage, forbearances on student loans. And he told me that the credit score will not reflect any of it. It's like the forbearance happened at the same time as a freeze on credit score. So then I asked him, so then how would a lender know whether the lender would get the right signal from looking at this credit score? What
Right.
is the true credit quality of it? And there's a long economic literature on how when you have information asymmetry, this is like an example of asymmetric information. That credit score used to be an objective metric that bridged the information asymmetry between lender and borrower, and then you have a fair market. But after this pandemic, what you have is this objective metric no longer is objective, and so the borrower knows something that the seller doesn't. The seller, all he can do is observe the credit score.
Hmm.
The borrower knows that he has been, not paying these loans and using it to buy cars, or, in fact, that is the kind of behavior that the Consumer Financial Protection Bureau has written a few very good papers on. What did the people who took on the student loan forbearance, what did they use that extra financial cushion to spend on? And what did they spend on? Cars,
Jet skis.
cars, cars. And in fact, I think Powell even, kind of briefly mentioned it in his presser in the last FOMC meeting, because he said sentiment sometimes could not accurately reflect how the economic activity will behave, because you could have somebody who report they think the future is poor, but they go out and buy a car. And I think he's implicitly referring to these a lot of people who received these stimulus checks, who didn't continue to pay their student loans, went out and buy a car during 2021 and 2022. And the increase in auto delinquencies we've seen starting in 2023 and then going on in 2024 are precisely the group who bought the cars in 2021 and 2022. And so I think there is certainly something to be said that I think one worrisome thing is that this credit score is used as key information metric for how lender decides on loans. And now, how many of them will be surprised by the deterioration in their asset quality? And what would they do in response to this realization that the quality in their loan book is not as good as it seems?
Yeah. All right. Well, I want to dig into that just a little bit more. So let me finish connecting these dots, and then I want you to answer that question, which is, so if it's unveiled that these credit scores are actually much worse than they initially thought, what does the system do, and what implications will that have for the economy and the markets? But okay, you've confirmed that we've had this deformation, upwards deformation of the credit score, right? So you could use this as an analogy of, like, we have an altimeter in a plane, and it's been monkeyed around with now, and it's not giving us a correct reading, which is bad. And it's giving us a probably artificially high sense of our altitude, which is bad, because if you're closer to the ground than you think you are, your chances of crashing go up. So we have this deformed metric. And so what that means is, if you're telling me your credit score is whatever, it's really not as good as it looks to me on paper. I just don't know that, right, as the seller. You combine that with the end of all this COVID relief that you mentioned, right? So during COVID, we were sending people those checks. They didn't have to pay their mortgages in a lot of cases, or the rent. And then, as of relatively recently, they didn't have to pay their student loans. All those have now basically gone back. Those have all gone away. The moratoriums, the checks, and the last shoe here is these loans now are going back into repayment. In addition to that, so basically, my credit score still hasn't changed, but my credit worthiness is now worse than it was, because I don't have any of that subsidy anymore, right? The third thing is that we also now have these pincher jaws coming in, which is because my costs are now going up, right? I don't have the checks. I have to pay my mortgage. I have to pay my student loans. I've got less money to spend, right? So that's going to crimp consumer spending. Also, as the lenders begin to wake up to this, as you said, they're going to start tightening their lending standards. So not only do I have less money to spend from what I'm earning or whatnot, but I'm unable to borrow as much money as I was able to borrow before, right? So we've got this pincher jaw that's going to be increasingly pinching consumer spending. We're still a 70% consumer spending GDP. So I guess my question for you, after connecting all these dots, Anna, is, could this be sort of this cycle's version of the subprime crisis, where, like, it's actually the student loan debt that lights the fuse that then creates the domino effect of contagion?
It's so in order to say whether it's prime or not, first of all, you need to have, back in 2008 it turns out that the mortgage-backed security were repackaged into many, many, ways, and it permeated the global financial system, right? I don't know we have that right now, so I cannot say, and it's impossible unless you have impossible to know unless you are working in, like, repackaging these things.
Mm-hmm.
And so I would say, Adam, it's impossible to say that it's like that. It's like 2008 subprime, but the mechanism of how there's an asset class that's decent size, sizable, significant, and that the quality of that asset class is not as high as you think, and you don't know where these asset class, who holds these stuff, and where these lending information asymmetries has occurred. I think it is a potential, but I cannot say that it is the same. However, one thing I would say is that it does have direct implication on the sustainability of consumption. That I think that the strong consumption in the past 4 years was bolstered by these things, and now, for all the reasons you just stated, basically the security net of being able to borrow easily, having this financial cushion, have all gone away. And so even the job market is weakening. So that's that additional layer of security of knowing that you can easily find a job is no longer there. And, oftentimes people associate working in the government as a security blanket, and you don't lose that job ever. But this year we are on track to see the federal government getting rid of, at least 700,000 jobs. And so I think I would say that one thing we can say with a decent amount of confidence is that consumption is on track to slow significantly this year.
All right, so consumption is set to slow significantly this year. Again, we're a 70% consumer spending economy, so that can only contribute to the slowdown that you talked about earlier. Um, and and then there's still this potential, and I'm not trying to make the case here that this is indeed the next subprime, right? But I think you've laid out a whole bunch of reasons to say, look, whatever's going to happen, it's not going to be good on a net basis. It's not going to be good. But I did hear you say that this could have, some real potential to, to spread, and maybe contagion is too loaded of a word. But to your point, okay, yeah, you're delinquent on your student loans. I'm going to hit your credit score. You're not going to be able to, borrow as much on your credit card. But hey, next time you go to buy a house, that's going to impact that, right? There's going to be maybe this sort of system-wide reset of really what credit worthiness is, at least for a good chunk of the population.
Meaning, Adam, if it's something bad like this does not always need to translate into a financial stability credit event, like a one Jacques Lehman thing. But however, it could be a slow moving train wreck, in the sense that it just means that the resilience of the economy and consumption would be much lower, because people won't be able to borrow. Borrow is a income smoothing mechanism, right? In times of bad, if you have reduced access to that, it just means the economy as a whole would not be resilient. And so if there's an exogenous negative shock to the economy, say tariffs, whatever, then if people could find ways to smooth their income or add to their income stream, then you probably would see like quick V-shaped recovery or something. That's what resilience is, right? However, if you have this impeded lending transmission, where if 10-year yields are reduced because economic growth slow, that bounce back from lending would not be as high as a typical drop in 10-year yields when things are healthy, right? So as a result, that recovery would not be as sharp, and it would be kind of a very slow recovery type of situation.
Okay, so that makes total sense. And again, I'm not trying to be hyperbolic, and I think that's a great distinction, which is, it doesn't have to be a Lehman moment where like the credit system locks up and it just doesn't work and the whole system is going to implode. To your point, it's just an increased handicapping of the transmission function. And so this could be, what'd you say, a slow moving train wreck, but just like a prolonged grind downwards, right? And I haven't heard people talking about this. I mean, a lot of people have been expecting recession for a lot of different reasons, but nobody's been talking about this. And I think that term protracted should be the one that maybe we should be spending a lot of focus on, saying, hey, maybe this isn't going to be a blink and you miss it recession, like we've kind of, people now think recessions are, based upon what we went through in COVID, that this could be something that could be the better part of a year, maybe even a 2-year process. Who knows? I don't know, but it's got the potential to be more prolonged than I think in living memory for many people recessions might be. All right, so real quick, you mentioned
Adam,
yeah, go ahead.
can I add to the point about the prolonged and protracted
Sure,
thing?
please.
Because I indeed think that's the right way to characterize this. And also just to react to the recession word. So I think generally people associate recessions with 2008 and 2020 type of recessions, because for most people, say on Twitter now, I look at the age group, the demographics of people who look at my Twitter account, for example, right? They're on the younger side, and they have not experienced the recessions of 2000 or 1990 and the previous type of garden variety recessions, which is often generated by inventory pullback, kind of like the story we're hearing right now. When you have a lot of inventory building, and suddenly there's a demand shock, and firms pull back, all sharply pull back. And that inventory swing is usually the drivers of old school recessions before 2008.
Mhm.
And also a second point about recession is that if a recession is perfectly predictable, then there won't be a recession. And we had seen that. I mean, I wouldn't say we had seen that, but we probably had seen that in the last 2 years, because everybody said, including ourselves, have said that for sure the Fed raising rates to over 5% will lead to a recession, because there's almost like a universal acknowledgement that that will happen. So the Biden administration officials took note, the Fed took note, and many of these policies I mentioned to you, the student debt, they just keep extending it. Many of these pandemic policies got extended along the way because of this worry that there's going to be a recession.
Right.
Right?
And the stealth fiscal spending, I think, was done to try to defray it as
Exactly.
well, right? Yeah.
Exactly. So if a policymaker knows there's going to be a recession, they're going to stop it. So that's what I would call, in today's context, it would be a Trump put. If Trump knows that everybody's told him, you know what, if you don't do this, there's going to be a recession. If he believes it, he's going to pivot, right? And then there won't be a recession, because then he would have stopped it. Same for the Fed. When the Fed thinks there is a recession, then the Fed would cut, like we did last September. The labor market was worrisome at that point, was indeed looking like it was slipping into recessionary territory. The Slum rule was triggered, and Powell cut by a jumbo size. And then now, by our estimation, some of the strong hard data we have seen, aside from being due to front running of tariffs, is actually partly due to the support to the economy from the rate cuts last fall, right?
Mhm.
Right. So were a recession completely predictable, either the Fed or the president could do something about it. But in this current situation, what we have now is that Trump is basically not using the stock market as a gauge of his policy success. The Trump put is actually pretty far away. And from my own experience, the thing that could shift the Trump policy would be more of what happens in the labor market. And so far, the labor market has not fallen off the cliff. And we need to see manufacturing hirings and layoffs spiking before I think Trump would be more willing to take deals on the tariff front. And we are very far from that point. And the second point is that the Fed put is also not here, because we have seen inflation expectations data, even though it's driven by partisanship, in University of Michigan, spiking. And even though the Fed is going to discount a bit of that, they are not going to totally discount it, because they are worried about inflation expectations. And so the Fed is not going to cut either. So when you have a situation where even as the risk of a downturn driven by inventory pullback is quite elevated, neither the side of the legislative, the executive branch, or the Federal Reserve are there to put a floor on what's going to happen. I think this is the mix which really increased the probability of a very clear-cut kind of recession. And, Adam, I refrain from saying that we avoided a recession the last 2 years, because, as you know, I've written a lot about how the labor data has been overstating the true strength of the labor growth. And I still believe that last year in 2024, there were 3 months where the non-farm payrolls was actually negative. So it could be that coming into this year, we were experiencing a recovery in the economy, which is kind of consistent with what, how typically in a late recession cycle, you see small caps rallying, and tech stocks would rally too, because they're expecting rate cuts. I felt like that was, coming into this year, we have some kind of momentum due to a combination of late cycle recovery, and then the Fed is cutting rates. And now we potentially are entering into either a double dip or a triple dip. So
All right. Well, look, I wish we had another 3 hours here, Anna. So on the point of the importance of the labor market, one, again, kudos. Last year, you guys, I think, knocked the cover off the ball in terms of your predictions for the unemployment rate. I think there was a pretty long string where Bloomberg Economics was the firm that was #1 in coming closest on your forecasts. I don't know if that record's continued into 2025, but I certainly remember it in 2024. The labor market really is kind of one of the last bulwarks between healthy economy and recession. It sounds like you still believe that the numbers there, there's some great inflation going on with the numbers that we're getting from the BLS. In fact, we just got the JOLTS numbers this morning, and they were not bad. We'll put it that way. I think they came in a little bit lower than expected, but not totally. And January's were revised upwards. Where do you see unemployment headed from here? I mean, I got to imagine well, I would think you would expect the unemployment rate to go up later on in the year, given that you're expecting this slowdown.
yeah, so this video will be published on Thursday, right? And then tomorrow we're going to be getting the March non-farm payrolls report. We are expecting the March non-farm payrolls to add about 200,000 jobs in March. So that's stronger than most forecaster and in a Bloomberg survey. And that's the reason why is that we think that March still experienced some rebound related to weather, bad weather in January and February.
In the front running too, right?
Yeah, in the front running and the trade and the logistics sector, you look at truckload rejection rates, which is a proxy for demand for transportation. The rejection rate has spiked in the first 2 months of this year, right? So that said, when we look at the daily home base data, which is the primary input into our labor market forecast, we see that around the middle of March, you start to see a very fast deceleration in the pace of hiring, and a pace that's faster than the last 3 years. So that's quite worrisome because it could imply that as we get into April, the next jobs report we get, so the one after this week, the one we get in early May would actually show a pretty weak payrolls gain. And in terms of the unemployment rate, I think the unemployment rate will show even a worse picture about the labor market than non-farm payrolls. And the reason why was that many of these DOGE-related layoffs, these workers are still being paid until closer to the end of the year. So they will continue to stay on the non-farm payroll survey. So they're actually counted as employed, even though they're no longer working. But in the household survey, which produced the unemployment rate, those people will report that they are unemployed because they have severed their relationship with the federal government. So I think the unemployment rate could be climbing faster than what the non-farm payroll survey slowdown would suggest, given this quirk in the statistics.
Okay.
So I actually do think that there's a good chance that the unemployment rate could overshoot 4.7% by the end of this year.
Okay. All right. Thank you for taking it there. So you expect it to be 4.7% or above by end of year.
Yeah. Yes.
All right. And I know you're very busy, but hopefully we'll have you back on at a few points between now and then so you can make some audible updates based upon the unfolding data between now and then. I don't want you to feel like I'm going to hold you to that number this early in 2025. Okay. Real quick, inflation. There's been a lot of resurgence and concerns about inflation, largely driven, well, both by its general stickiness, which may be due more to base effects than anything else. Love to hear if you think that's the case or not. But obviously, tariffs have a lot of people thinking tariffs equals inflation. As you said, we got to go through this 4-phase process before we really know the answer to that. I would think, given again your macro outlook that you've laid out for us, that you might take the under on inflation, because it seems like you think the economy is going to slow more, the unemployment rate's going to rise more. Is that true, or is it more nuanced than that?
I Everything with inflation is more nuanced. So Adam, let me go back to my phase one, two, three, four for the tariffs implementation, right? So where the inflation start being affected by tariffs would be phase three, as I mentioned, where the the firms have finished running down their build up inventory and now they have to decide how much more to build up. And because now it's these new inventories are more expensive, they also have to decide, are they passing through or will they not pass through? And at this point, if the macro conditions is such that the labor market is still holding up, say
Mhm.
if unemployment rate when we get to September is still only 4.3 or 4.4, I would say that firms will try to pass through these prices. They would
Okay.
try. I mean, there's no harm in trying. I mean, the harm would be that they will realize that later on that the demand would fall by more than their pass through. So
Yeah.
this is back to the concept of elasticity, right? A good is elastic if a firm increase prices by 10% and the decrease in the demand falls by more than 10%. So in that case, their revenue fall, right? So then a firm would try to fine tune to get to the, point where it minimizes the total revenue loss. And I think it's kind of like a learning process. A firm will try to pass through, and if if it turns out that the demand at that stage and the elasticity faced by the firm is actually way more elastic, so the fall in revenues in demand is much larger than the pass through, then they won't be able to pass through as much
Mhm.
because they don't want that much of a revenue fall. And so I think this process of testing to see how much they can get away with, that's the uncertain part. How long does it take before they realize that they have to really cut prices or they have to take the margin hit? So in terms of macro models, like large macro models, um, it seems like there will be a long lag before that disinflationary impact would happen. Because before you start to, when firms realize they really cannot pass it through, it would be because the macro conditions has deteriorated to a point that's really bad. And that takes time because the labor market does move very slowly. So I think the the point where it would be clearer that in fact the net effect is disinflation would be by middle of 2026, given
Ah,
the lags of all these stuff.
okay. So don't want to put words in your mouth, but do you think that inflation then will kind of be sticky, sort of hovering around where it is now, more or less, until then, and then we'll know quickly whether it's game on for inflation because they can pass through the price increases, or it's disinflationary because they can't.
So I'll tell you what we did. So we did mark up core PCE by a couple tenths of a percentage point for
Okay.
third quarter. But for next year, end of 2026, we do have it. We do have it marked down in the middle of 2026.
Okay. All right. All right. Well, look, thank you for that. So, Anna, just fantastic. So well thought through, so specific. This is an interviewer's dream. Thank you. As we wrap up here, so the audience here are regular people, just trying to figure out how to hopefully prudently grow their wealth to provide for their families. They're more nervous this year than they were last year for sure. Last year, they were on the second year of two great back-to-back year in the markets. This year, very different. After listening to your macro outlook, they might even be a little bit more nervous. Um, any any advice for that person in terms of, it sounds like I think you've already delivered the message. Hey, plan for an unhappy stock market in the latter half of this year. because, as you said, sort of no matter which way phase 4 goes, it's not going to be great for the markets.
Yeah.
Uh, are there any investing strategies that seem like they would make a lot of sense for the type of road that you see ahead, or any potential asset classes that you think would perform particularly well or particularly poorly?
Yeah, so I'm a macroeconomist, so I really can't give very specific investment advice. But from a macro point of view, and very broadly speaking about asset classes, I would try to not be as exposed to as the stock market for sure, because as you know, as I mentioned, that either way, in either path, whether the firms can pass through or the firms cannot pass through, you're going to see the stock market being hit by this. And in fact, looking at the trade policy uncertainty index, how we're currently 3 times as uncertain as the 2018, and thinking about how the tariffs back in 2018 affected S&P 500 then, I think 30% adjustment in the S&P 500 is not out of the realm of possibility. So if you think about that tail risk, if you don't need to believe that will happen, just entertain that possibility that S&P 500 could fall by 30%. Then what would you do? Well, you also certainly we cannot say for sure that tariffs are inflationary or disinflationary. So I also would not take a very definitive stance on assets that either expect high inflation or asset class that's low on inflation. I would actually focus on assets that is acyclical and agnostic on the business cycle, if such asset classes exist, and also focus on the structural trends. So what are the structural trends? Even if we come out of, the next 4 years, next 3 years, what trends still exist? I recently reread Bill Grove's book, a book that he wrote in 1990s. I think it's called How to Invest What Everybody Why Everybody Say is What Everybody Say About Investment is Wrong, or something like that. It's a book written by Bill Groves, and there was a chapter where he said if he were to go to a remote island for many years, and before he go to the remote island or after he come back from the remote island, what is the one data point that would be sufficient for him to think about investment? He says demographics, and he's right about that. Demographics is perfectly predictable, and in terms of the structural demand for housing, for stocks, it is a function of the prime age group, right? By being able to predict how like the ebbs and flow of the size of these prime age people between age 30 to age 45, where they'll be spending a lot, because these are the most indebted people. They buy things, they buy houses, they start a family, they take care of older parents, and by following that, you could have a pretty decent guess of what demand on things generally be looking like in 5 to 10 years. The second structural trend is AI adoption, right? And the key word here is not AI. The key word here is adoption, because I think one could say there have been, many people have said the NVIDIA stocks and various AI chip stocks have been driven higher already, is out of reach for most people. But the next phase of AI is adopting AI. And I mentioned the demographics trends, right? There we have, baby boomers now. The last of baby boomers is likely entering retirement this year. And so you have this very sizable distribution of people age 65 to 80, and they'll be requiring more healthcare. AI actually has become a pretty promising and cost-efficient way of servicing the healthcare needs of this older population. And so I think there are a lot of very interesting structural changes related to demographics in AI that will be insensitive to the business cycles that that we are experiencing. I think people should explore more of that and develop their own opinion on what would be the structural trend for the
All
next
right.
5 to 10 years.
Fantastic and great point. And much less intelligently, I just sort of think about it as try to find a force of nature that no matter what else is going on, that force of nature is going to overpower it going forward. And obviously, the aging of the boomer demographic is one of those forces of nature, right? All right. Fantastic, Anna. Well, look, very quickly, folks. If you've enjoyed this conversation with Anna as much as I have, please let her know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help from a financial professional in terms of helping you figure out how to navigate this quite rocky road that Anna thinks might be likely to happen from here. If you don't already have a good financial advisor already advising you, then consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those free consultations, just fill out the short form at thoughtfulmoney.com. The firms will be in touch with you right away. And as a reminder, these are totally free. There's no commitment to work with these firms. It's just a free public service they offer. While you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the site to sign up for our newsletter. And I want to give another thanks here to Anna. So for our Macro Pass subscribers, the premium subscribers to our Substack, we're going to have a recent piece from Anna coming out later this week, basically her team's reaction to the Liberation Day data once we know them the day after we're sitting here recording this video. So anyways, Anna, I want to thank you for that too.
Thank you. Thank you for having me again, Adam.
Anna, it is always such a pleasure. I'll be following you very closely. I highly recommend everybody else does too. Where should they go to follow you?
So the first place is on Twitter. So my handle is at Anna Economist. And the second way is if you have a Bloomberg Terminal subscription, our pieces, written pieces and thematic pieces can be found on Beco Go, B-E-C-O Go. And you can even see written pieces by my colleagues who cover the economy of China, geopolitics, Europe, from all over the world on Beco Go.
All right. And Anna, when I edit this, I will put up the links to the URLs to those on the screen here so folks know exactly where to go. Folks, the links will be in the description below the video too. Again, Anna, just such a pleasure. Thanks so much. Looking forward to have you back on in Q3 to give us an update.
All right. Thank you, Adam. Bye.
All right. And everyone else, thanks so much for watching.